formations. You've seen how supply and demand drive price in a conceptual sense, and on the logical side of it, you've seen how this imbalance of supply and demand is what's behind price movement. So now we want to look at the formation or pattern on a chart that represents this imbalance of supply and demand. This is going to lead us to where a potential big stack of unfilled institutional orders is sitting. Let's look at the demand side first. The first picture of demand we have is called a drop base rally, or often written as a DBR. What this looks like is a drop in price followed by a sideways or basing action and a rally out in price. At that base, at the origin of the rally, that's going to be where our demand zone is sitting. That's where the imbalance between supply and demand is at. When price rallies out of this basing or sideways action, we know that this could have only happened because the sellers ran out at this base. There were no more sellers, but there were still some people that wanted to buy it, and so we get this rally out in price. Because the sellers ran out, not all the buyers were able to get their buy orders filled, and so this leaves behind these unfilled buy orders. This is where our demand zone is. The second picture of demand is a rally-based rally, or RBR. And what this looks like is a rally in price followed by a basing or sideways action and with a rally out in price, a rally out from that basing action. Just like the drop base rally, at the base is where we have the origin of the imbalance, where the supply and demand is largely out of balance, and this is going to be our demand zone. You'll notice that what's common between these two formations is that rally out in price. It doesn't matter if price drops into that base or rallies into that base. What defines these as demand zones is that leg out being a rally. The way that price moves away from the zone is going to determine whether this is a demand zone or a supply zone. So the fact that price moved away by this strong movement up, these big green candles, that's what's going to define these as demand. On the supply side, we're essentially going to have the flipped picture of this. If we just took the pictures of demand and turned them upside down, that's what we're going to see on the supply side. So the first formation we have is a rally, a base, and a drop, often called an RBD or written as an RBD. And so at that base, prior to the drop, that's where the supply is sitting. That's where the origin of the imbalance is. For price to drop out of here, this could only have happened because the buyers ran out, or all the buy orders were filled and there were none left, but there were still some people who wanted to sell. There were still some willing sellers left behind. And so price drops from there. So at the origin of that drop is where the unfilled orders are sitting, where those leftover institutional unfilled orders are going to be. That's going to be where our supply zone is at. The second picture of supply is going to be a drop base drop, or DBD. And on a chart, that's going to look like a drop followed by this basing or sideways action and a drop out in price. At the base, just like the rally base drop, is going to be where the supply zone is sitting, where that imbalance between supply and demand is at, and where the willing sellers are left behind. You'll notice that what's common between these two is that drop out in price. That's what defines these formations as supply zones. It doesn't matter if we get the rally into the base or a drop into the base. What determines these zones as supply zones is that drop out in price, those strong red candles coming out of the zone. So now we know what the two formations are that we're going to be looking for when identifying demand, a drop base rally or a rally base rally. Once we identify one of these formations on a chart, the action that we will look to take is to buy when price returns to the zone. So as price retraces into the zone, that's where we're expecting prices to rise. And so in order to buy low, sell high, we're going to buy here inside this demand zone with the expectation that price will rise to higher prices and we can sell high later for a profit. Now, when we find a rally-based drop or drop-based drop on the chart, we know now that this pattern is representative of supply. And so our action to take when we identify a supply zone is to sell short when price retraces back into that supply zone. As price returns to the zone, we're going to place our sell short order in that supply zone with the expectation that prices are going to decline so that we can sell high at this supply zone and buy it back later at a lower price for a nice profit.